Welcome back. The Nasdaq sitting at an all-time high as Nvidia tops $4 trillion in market cap. So does the rally really need a rate cut to keep going here? For more, let's bring in two people with two different points of view on that. Darrell Cronk is Chief Investment Officer for Wealth and Investment at Wells Fargo, and Michael Kantrowitz is the Chief Investment Strategist at Piper Sandler. I don't know if I'm making too much of the differences. Welcome to both of you, gentlemen. But I believe, Darrell, you see only one rate cut this year, maybe only one next year. And Kantro, you're looking for maybe some cuts more quickly. So, Darrell, let's start with you and why you think this is a Fed that won't and shouldn't cut rates too much from here.
Yeah, I mean, basically what we have right now, Kelly, is one rate cut for 2025 for the remaining meetings of this year and one in 26. I think it really circles around 2 points. One is we think neutral rate is somewhere around 100 basis points over inflation, right? Or 100 basis points real, they call it, right? So if you look at the core PCE on its last reading, it's 2.7, which is the Fed's preferred measure. Tack 100 basis points onto that, you're 3.7. The 2-year today is around 385, which is about 50 basis points below Fed funds today. So 2 makes sense, right? If you calibrate it that way. It does sound like, Powell is starting to lean a little more dovish and maybe want to cut in. We think September is probably a live meeting. But I don't think, the markets need aggressive interest rate cuts or many interest rate cuts to make things continue to move higher.
No, if anything, based on the data you're citing, we're priced for only a couple of cuts, and we're already at all-time highs.
That's
it's not
exactly
like you said
right.
we're priced for 2 points worth. Michael Kantrowitz, you're looking though at some of the data, some of the high-frequency indicators, and what are they telling you?
Yeah, each month we look at our HOPE framework, which is looking at housing, PMIs or orders, profits and employment. And it's really been reflecting the same story for the last 2.5 years. You've got a very bifurcated economy. Housing is obviously one of the weakest parts. We look at all the PMIs in the U.S., they remain broadly in contraction territory. That's been the case for several years. Profits are very bifurcated. S&P 500 profits are at new highs. Small cap profits have been down for 3.5 years. And employment continues to soften. So my point about rate cuts and why Trump is right that we do need rate cuts is that this economy and the stock market continues to be very narrow. And without lower rates, we're unlikely to see any broadening of fundamental breadth.
Darrell, do you want to respond to that and also talk a little bit about, you look across the market, we have Nvidia at $4 trillion. We do have some of the narrowness issues that Michael references. But how do you feel about the market, broadly speaking?
We actually still like the market here. And I guess Michael's right. I mean, housing's been weak since 2022, right? Whether it's new home sales, existing home sales. We saw a nice spike in mortgage applications this morning, but it's been weak across the board and has been for some time. The reality is this, right? I mean, at a 4.1% unemployment, unemployment or the labor market is not showing that the market or the economy needs interest rate cuts at this point. And if you look at, where we're tracking on Q2 GDP with some data yet to come, we're probably somewhere in the mid to, call it 2.5%. So 2.5% GDP growth, 4.1% unemployment, that doesn't scream to me Fed must cut rates or we have some kind of a problem. Granted, there's a lag effect there, but, we've got Q2 earnings season kicking off next month. The economy has never, and I mean never, you go all the way back to the 1940s, entered any kind of a recession or material slowdown period when year-over-year earnings growth is positive. And it looks like consensus is tracking 5 to 6% earnings growth for this quarter in Q2. If you assume some level of beats, you're probably talking 7, 8, 9% earnings growth on the back of Q1's 15% earnings growth. So I'm not sure the case is there to say, oh, the Fed must cut rates, needs to cut rates, or should cut rates.
And Michael, I know you think that we should, or that there's maybe some signs that while all may be fine-ish now, it sounds like you're kind of saying spin this forward a quarter or two.
Yeah, I think it's hard for the Fed. They have a really hard job now because the economy is so bifurcated. When you're setting policy for the economy, you've been increasingly looking at the largest companies and the wealthiest consumers. And those smaller companies and lower income consumers that do have to service higher debt rates do tend to pay higher interest rates, as do small businesses. They're getting left behind and they're getting overlooked in the aggregates that, again, I agree, look fine. I don't think the economy is heading for recession, but I think the Fed needs to be more clever, as they've been in recent years, to try to help those that are very rate sensitive. And yeah, it's not the NASDAQ. It's the Russell 2000. It's housing. It's smaller businesses. It's lower income consumers. So they need cuts.
I know we have to go, but would 2 cuts do it, Michael? I mean, in that sense, both of you and the market would all agree.
I think any decline in long and short rates would certainly be helpful to bringing us back to something that's been missing, which is a broader economic recovery or backdrop, and also a broader broader stock market.
All right, I've given up on the small caps. Like, I know they're finally coming back, and people say they're breaking out, but it's like a bad relationship. Darrell Cronk and Michael Kantrowitz, appreciate your time, both of you, this afternoon.